So timeframes are broken into three scopes. Your macro is your overview, the foundation of your trading, is where you conduct forensics, and you look at your higher time frame. This is where you extract your bias from. Your micro is where you're building context for your setup. And your entry/confirmation is where you execute and manage your trade. So for a quick answer, if you're a position trader holding a trade for over a quarterly span, use your monthly as your macro, your weekly as your micro, and your daily as your entry/confirmation. If you're a swing trader with the intention of holding a trade for over a span of a week or two, use your weekly as your macro, your daily to the 12-hour as your micro, and your 8 to the 4-hour as your entry/confirmation. If you're an intraday trader where you hold a trade for a day or two, use your daily as your macro, your 8 to 4-hour as your micro, and 30 minutes to the 15 minutes as your entry/confirmation. For scalpers who aim to only hold a trade for under an hour, use your 4-hour to the 1-hour as your macro, your 30 minutes to the 10 minutes as your micro, and 5 minutes to 1 second as your entry/confirmation. So basic common knowledge when it comes to price action is that your time frame is directly correlated with the volume in the market. And the volume in the market is the points per day. So what you want to do is you want to go on any Forex volatility calculator. In this instant, we're using the investing.com. And go and check your volatility in the past 13 weeks. Why 13 weeks? Because that's the quarter. That's a quarter of a year. And you would want to see how many points is price moving every day. And that will indicate the volume. So in this instant, you have GBP USD. It moves 102 points per day for the last 13 weeks. And then you have smaller pairs like your GBP, where it only moves 47 points. So the higher the amount of points it moves per day, that means the higher the volume. So you would want to use a higher time frame. Your higher time frame, as far as your macro, micro, and your entry, would be a bit higher. And let me show you an example. Trading GBP USD, due to the volume, I'm using the 2-day time frame as my macro. And the first thing you see is a bearish time frame. So I know it's in my best interest to be a seller. So first thing I would do is I would mark up my danger zones. I'll mark up my levels where I can anticipate the order flow to start reversing. And of course, if you're using the 2-day time frame, price will start reversing at an earlier time frame. Of course, a 4-hour would reverse way earlier than the daily, and the daily would reverse before the 2-day. So I'll mark up my zone. And of course, like anybody that's been following me for some time, you know that we want to take advantage of the order flow. We don't want to anticipate an order flow change. We want to react to it. We want to see that price already shifted gears, and we're taking advantage of the institutional sponsorship. So now I would go to the 8-hour. And of course, knowing that the 2-day time frame is bearish, on the 8-hour, we're looking to see any signs of weakness. Maybe a base created under a selling pressure, or even any other internal liquidity created after a sequence of a selling pressure. So we can see a rejection here, but price is still not folding. So as our micro goes, we don't have anything determined yet. We need to see an impulse move. Okay, so now we have our impulse move. That means there's selling pressure coming from this area. So what you would do next is you would go on your entry/confirmation. And in this instant, I would use the 1-hour. Why am I not going lower? I'm not going lower because of the volume. As we've seen, this pair moves 100 points per day. So it wouldn't make any sense for me to trade from an intraday perspective on the 15-minute or the 5-minute time frame. So now this is where you can start looking for your entry. What do you see? Do you see any valid entry? You can see a unmitigated order block. And this could be your entry, and you can have your stop loss at a pretty tight position just for the fact that if price does come up and revisit this area, you're more than likely to reach a consolidation for a stop hunt to occur in your macro area again to push price down. So there's no point of having a stop loss all the way up here or even higher than this point, even targeting this level, because once price reaches back to our macro base, price will more than likely reverse. Hope you guys liked the video. Make sure you like, share, and subscribe, and make sure you comment what video do you guys want next.